The following talk was recorded in Munich in June 2017 during an educational event about volatility as an asset class. The event was organized and sponsored by the German Association for Alternative Investments and the Kaya Association. My agenda is to develop two fairly important arguments. Firstly, we will examine the asset class volatility in the context of other traditional asset classes. What is it? Where does its return come from? How does it relate to other risk premiums that we are familiar with? However, my second argument is the one I want to stress most. Hopefully, you will leave this event convinced that being exposed to the volatility risk premium is indeed the most attractive way to position yourself as an equity investor. It is strongly related to the equity risk premium, but more stable in its involvement. To develop these arguments, I first would like to establish a common knowledge base. This might bore one or the other, but it's necessary. So to begin with, we will look at the two main aspects by which asset classes should be differentiated. Firstly, what is the service we provide to others in the capital market when we invest into a specific asset class? And I mean the type and the quantity. And secondly, we will look at the different ways an investor can gain exposure to one and the same asset. This is when we introduce optionality and the concepts of delta, gamma and vega exposure, which for us simply describe different ways to build an exposure to a specific risk. So let's begin with an analysis of the type of services rendered in the capital market. I think there are two. The most important one being the provision of liquidity. This service is remunerated by an interest rate that we decompose into two parts, the so-called risk-free rate, which in fact has been abolished, but which used to be an incentive to save. So in today's environment, we are actually being incentivized to consume. And then the so-called term spread, which remunerates an investor's willingness to provide liquidity over the longer term. By committing my capital over long-term horizons, I expose myself to the risk of a price change. I mean an inflation risk, and this ought to be rewarded separately. This is what the term spread is for, an add-on to the risk-free rate. The second type of service is to bear equity risk. The equity risk premium rewards the investor for his willingness to bear the uncertainty attached to the value creation process of the economy. I mean the risk associated with uncertain corporate cash flows. I believe each asset class can be depicted in such a 2x diagram. To the left, in red, we show the term lengths of the liquidity provision, short-term and long-term. This red area encompasses the so-called default-free investment universe. And secondly, now equity risk comes into play. And honestly, it is of no relevance if you agree with me or not about which asset class entails more or less equity risk. That's not the point here. What I do believe that we all agree that when we invest into mezzanine capital, corporate bonds, equity or anything else shown in green, we are in fact also exposed to an uncertain economic development. Now, what I really want to show is that the volatility risk premium is a very special way to position yourself. The volatility risk premium, like shown in the previous presentation, is the return derived from spreading implied versus realized volatility. This asset class is most likely the most aggressive, the purest way to build equity exposure. With, however, one very important feature: you do not provide any sort of liquidity. In fact, the opposite is the case, given that by receiving premium, one is, if anything, absorbing liquidity. Before we come back to this point, what do we mean by shortfall participation? And I will now proceed very intuitively. So to all mathematicians, physicists and quants, my apologies, because we will now build a drastically simplified and intuitive approach to the equity risk premium. This is how we will introduce the difference between a delta-based exposure, a vega-based exposure and a gamma-based exposure. You don't have to know what these Greeks mean. This is of no importance at this stage. To develop our argument, we start with the following analysis. Let's assume that equity returns are distributed like that. We see an overproportional number of large losses here to the left, but more importantly, we see an average return of 6%. And it really doesn't matter whether we look at yearly or daily returns. I think it's quite obvious that on average equity returns are positive. And this bar shown now is how I intuitively like to think about the delta type risk profile. Someone purchasing equities in a traditional way, by buying an equity fund, an ETF, or an equity future, will be evenly exposed to all phases of the shown stochastic distribution, more or less always with the same risk profile. There are these loss moments that you will have to sit out, and there is this blue area, which is slightly larger, the winning moments. But why is it that we have this average 6% equity risk premium? I reduce it to something very simple and mundane. It is the remuneration for our willingness to bear the equity exposure throughout the red phases, for us to sit out the shortfall moments. For that we demand a positive average return. This is our remuneration. And frankly speaking, this is how we all would like to have it. This is what investors typically demand from their wealth managers. Please be long during all winning moments, but stay out of the big loss moments. So we have to try to do something to cut off these big shortfalls. And actually, that's not so difficult to do. All we have to do is to buy a put option that I penciled in symbolically with the dotted line being the strike. And here you see the phase during which the intrinsic value has not yet reached the full option premium spent. And from here on, you are no longer the equity holder. You're hedged. Someone else is bearing the risk. It's as simple as that. However, to do that, you need to find someone willing to bear this type of risk profile. This is the risk profile you acquire when you sell optionality. To build this type of exposure, you must always sell some sort of optionality, be it by selling volatility futures, going short options, entering into dispersion trades, or something similar. There are many, many ways to position yourself like that. But the interesting question now is, and this is a really important question, how much of the long-term average equity risk premium that we expect to earn by being an equity investor must we cede to those investors willing to bear the shortfall risks? And as in every economy, a diminishing marginal utility for wealth prevails. Nobody wants that risk. Therefore, we probably must cede a big part to those willing to bear this risk profile. And what we are going to do next, we will look at this empirically, not analytically. We are going to reduce it to an empirical exercise on the S&P 500. We will analyze the isolated return evolution of a poor delta exposure, a poor vega exposure, and a poor gamma exposure. We begin with the delta exposure, and what we see here has already been shown a few times today. We depicted to the right in blue the VIX, and then we see a delta type exposure to the S&P 500. This one is a bit special because for one, it is shown in a logarithmic scale. Secondly, we only show excess returns. And thirdly, we have normed it to a 10% portfolio volatility. 10% portfolio volatility because I will now show you the performance evolution of gamma and vega isolated over the exact period of time and also with a 10% portfolio volatility. That are the two lines that we have just zoomed in, gamma and vega. Quite frankly, I prefer gamma. It's much more stable, less volatile, and as such, in my opinion, actually the more attractive way to build exposure to the equity risk premium. Now, before we draw some really insightful conclusions from this graph, let me give you the chance to understand how these three lines were computed. I argue that the underlying risk to all three is an exposure to the equity risk premium. In order to build a delta type exposure, you buy equities. Your operational sources of income are dividends and capital gains. And the following is important. The remunerated service you're providing, the economic reasoning for a positive return, is the liquidity you provide and the equity risk you bear. If it's pure vega exposure you're looking for, and really that's what I like about the VIX, and the VIX futures in particular, it is an instrument, tradable since 2006, that allows us to build a truly pure vega exposure. How it is implemented? You need to sell volatility futures and then roll them as they mature. And it makes no difference whether you're selling monthly, 2 months or 3 months futures. In our case, it's monthly futures. Your operational source of income now is the return earned by the future rolling along the term structure of volatility futures. And a point that I would like to stress now in particular is what is the service we are providing hereby. Two observations that I want to point out. Firstly, I see no provision of liquidity by this activity. It's just the VIX futures you are selling. You are not lending any money. You are only behaving like an insurance provider to capital markets. And it is indeed a very special kind of insurance you are underwriting. You are promising to deliver to someone else a profit during phases of rising uncertainty. That is how you become an insurance provider. And I think it is worth noting that this insurance provision is in no mathematical causality to the direction of the equity market. The second way to position yourself as an insurance provider is to build a so-called gamma exposure. This is what I would like to focus on for the rest of the presentation. In order to build a gamma-type risk profile, you must indeed sell options and play the spread between implied and realized volatility. Actually, let me correct that. You don't have to explicitly sell options. You could also enter into a variance swap, which is effectively the same. One can be replicated by the other. Your source of return, however, is in both cases the difference between implied and realized volatility. What is the service being provided? Again, we are not providing liquidity when we sell options. We are not lending out any money, even less so if you do this in a delta hedge fashion. What you're actually doing is you are approaching a third party and telling him, look, I'm going to grant you an insurance that covers all losses incurred due to a market move that is bigger than the one we are currently anticipating. That's all. Now we have a causal link to the underlying, because the magnitude of the S&P 500 up or down move will eventually determine the payout of the damage regulation. So, is it important to understand all this in detail? No. The important takeaway is the economic logic we built. Really the last block we looked at, the economic service being provided. And now I want to draw a few arguments from this chart. The first argument is actually quite trivial, but I do think that it is important to be very aware of the following fact. These three different ways to engage in equity markets produce highly correlated performances. I strongly believe that it is impossible to build a long carry position that is not correlated to the equity risk premium. They are all positively correlated. And the reason for this is the fact that the common denominator of all three types of exposures is the uncertainty. When uncertainty rises, price-earning ratios go down, so delta loses. Implied volatility goes up, so vega loses. And the market's realized volatility increases, so gamma also loses. That does not mean that we do not have to intensively deal with the diversification and alternative earnings potential that vega and gamma-based risk exposures offer. Because, yes, they diversify indeed. And now, once again, let's be simplistic and restrict the analysis to the extremes, delta and gamma. As vega is in between, the following arguments also count for vega in a reduced form. Yes, gamma diversifies indeed, and quite significantly. Why? That's what we infer mathematically from this correlation table. It shows the correlation of delta and gamma exposures in falling equity markets. This 3-month correlation of 0.36 means that only in 1 out of 3 periods, and I mean 3 months periods where equity is lost, gamma has also produced losses. That means it recovers quicker, and we already showed various reasons why that is so. Here, I try to explain in really easy terms why gamma recovers so much faster. When you have a delta exposure, you lose, irrespective of the speed and the magnitude of the sell-off. Even if the market only falls by 0.3 per day, you will have lost 3% over the course of 10 days. If your exposure has a gamma profile, you will only lose if the market sells off faster than it did in the previous days. Well, because the options market is very reactive. That is particularly the case for short-dated options. The level of implied volatility is very quickly adjusted to the most recently experienced realized volatility. That means, after a Lehman event, volatility immediately jumps to levels of 40, 60 or 70. Now realized volatility must be in the magnitude of 5% per day for the gamma exposure to continue losing money. This explains why, when you take a bit of time to look at these drawdowns, you will observe that gamma actually turns around a bit faster. Gamma will also fall first, but it turns around quicker, and that is a very nice feature. Okay, all of this so far was actually of no relevance, because we wealth managers and volatility managers typically try to derive the quality of gamma and vega exposures by looking at the so far elaborated different ways to build exposure to the shortfall moments of equities. But that is indeed a waste of time. That's not the reason. The reason why gamma has such a better return, it's more attractive. Actually not a better return. It only has a more stable earnings profile than a traditional delta exposure. This is what I'm going to show you now. This graph shows the long-term performance of the S&P 500 beginning in 1997. No log scaling, just the simple wealth accumulation of a 100% allocation in the S&P 500. And what you see depicted as gamma is the performance of a continuously rolled 100% short straddle position on the S&P 500. The reason why gamma is so stable lies in the fact that gamma exposures do not come along with any sort of liquidity provision. Gamma and vega do not absorb liquidity. And we typically assume that markets move around because changes in the level of uncertainty drive volatility. I don't think so. Probably less than 10 to 15% of what we observe in terms of market movement is indeed caused by changes in the perceived uncertainty. The major part of market movements we observe is rather due to more or less liquidity supporting asset prices. What do we mean with liquidity absorption? Let me illustrate what I mean when I talk of an asset's ability to bind liquidity. When we increase the money supply in the economy, and there are two ways this can be done. There's a central bank that expands its balance sheet, and there's a private banking system that works with a variable money multiplier. And by the way, the latter is probably of more impact than what the central bank is actually doing. Anyway, money supply does change, and when it grows, one of the two or both must happen. Either consumer prices go up, causing inflation, and as such absorbing the additional liquidity, or the prices of capital goods appreciate, thereby absorbing the excess liquidity, or both. Now, which assets can absorb liquidity? Equities can bind liquidity, properties, old-timers, probably even wine, bonds, corporate bonds, farmland, and so on. But gamma cannot. Even less so an options portfolio built with short maturity options. Just think of it for a moment in the context of liquidity absorption. You sell an option with a bit of premium income, and in a month's time it's all over and you start anew. There is no liquidity absorption. And that explains the difference. We look at the same chart, but we included a depiction of our liquidity expansion and liquidity contraction phases observed over the past 20 years. At the beginning of each new phase, after a turnaround, we reset both charts to 0. The colors did not turn out very well, but anyway, the light green shadowed areas are liquidity expansion phases, and the pink shadowed areas describe liquidity contraction phases. These are not interest rate cycles. Liquidity and interest rate cycles are often confused. These liquidity contraction phases, in fact, often go along with falling interest rates. However, with the banking system unwilling to take on risk and thereby contracting the money supply. And that never happens voluntarily. This is fascinating. Liquidity contraction phases never occur by choice. The point I'm making here is that option strategies, like ours, like the one shown before, like many other similar carry-oriented concepts, we aren't devil's work. We are only exposing ourselves to equity risk, but in a way that leaves us significantly less exposed to the valuation distortions caused by changes in the money supply. And with that, I conclude my presentation, and I thank you very much for your attention.